Welcome to this explainer. If you follow the employee benefits and insurance sector, you're probably well aware that quarterly earnings reports can sometimes feel like a massive maze of actuarial adjustments and, frankly, really dense financial jargon. Well, today, our goal is to cut right through all of that. We're going to unpack Unum Group's actual Q2 2026 performance, looking closely at how they're managing their legacy risks, driving top-line growth, and ultimately creating real, tangible value. Okay, let's dive into this. We're going to start top-down. First, the big picture, then rewarding the shareholders. After that, we'll break down the Unum US segment, International and Colonial Life, and the closed block, before finally wrapping up with the outlook for 2026.
Right off the bat, let's immediately answer the most burning question on everyone's mind. Yes, the company absolutely made money. A lot of it, actually. Unum Group brought in a massive $346 million in after-tax adjusted operating income for the second quarter. To put that into perspective, that translates to $2.16 per diluted common share. That is a substantial figure, and it really sets a very solid foundation for the rest of the quarter's narrative.
Section 1. The big picture. To truly understand where that $346 million came from, we need a macro-level review of the company's overall financial health. And this brilliantly illustrates the sustained core operations top-line trends. Premium income is up to over $2.8 billion for the quarter. Now, while net investment income did see a slight dip, the sheer volume of premium income and total revenue, which hit $3.37 billion, shows us a core business engine that is running incredibly smoothly.
And that momentum, it's definitely echoed by leadership. President and CEO Richard P. McKinney summed up the quarter by stating, "We delivered another solid performance in the second quarter across multiple dimensions." He went on to highlight steady premium growth, healthy operating margins, and a remarkably strong cash flow profile. It's a highly positive tone that points directly to the sheer strength of their diversified employee benefits model.
So, breaking down McKinney's perspective, we can see the specific growth engines driving all this success. On a constant currency basis, premium growth hit a very steady 3.6%. But it's not just about bringing new money in through increasing sales, they're also maintaining really good retention of their existing client base. And perhaps most impressively, they achieved a 21.4% adjusted operating return on equity in their core operating segments. That right there is a hallmark of very healthy operating margins.
Moving right along to Section 2, rewarding the shareholders. So what happens when a company's core operations are generating that kind of reliable margin? Well, we shift our focus to value creation. Because of that strong cash flow profile we just talked about, plus a robust balance sheet featuring $1.5 billion in holding company liquidity, Unum was empowered to be highly generous this quarter. They executed about $200 million in share repurchases and paid out $73.5 million in common stock dividends. That brings their year-to-date total capital return to a staggering $750 million.
Let's look at how this builds long-term foundational value for the investor. When we look at the year-over-year momentum, the tangible results of these capital returns are super clear. The book value per common share grew from $65.76 in the second quarter of last year to $68.28 this quarter. That's a solid 3.8% growth in book value, which signals a really steady, managed expansion of the company's underlying worth.
Section 3. Unum US segment.
Having established that macro strength, it's time to drill down into the micro-level performance of Unum US, which is the company's largest segment, to find out where the money is actually coming from. Overall, Unum US saw a 3.6% increase in adjusted operating income. But now, what's really interesting about this slide is the stark contrast between the different product lines. Group life and accidental death and dismemberment had an incredible quarter with a massive 32.8% jump in income due to lower claim incidents. Supplemental and voluntary lines also rose 8.2%, but look right at the top. Group disability, despite having the highest premium income, actually experienced a 17.4% decrease in adjusted operating income, dropping to $103.1 million.
So, why does this matter? Well, understanding that dip in group disability is absolutely key to understanding the nuances of this quarter. The drop was primarily driven by what's called short-term disability incidents. Basically, that's just the rate of new claims being filed. Unum saw higher incidents this quarter, particularly related to their paid family and medical leave products. This specific headwind pushed their benefit ratio up to 65.8%, which effectively ate into the operating income for that line even as premiums were growing.
Section 4. International and Colonial Life.
Leaving the primary U.S. segment, we move to the secondary segments, starting with a major domestic win.
Colonial Life just continues to be a total powerhouse for Unum Group. They enjoyed a 3.3% bump in premium income, mostly driven by prior period sales. But the real headline here is their operational efficiency. That efficiency translated into an impressive double-digit 11.9% increase in adjusted operating income, bringing them all the way up to $131.4 million for the quarter.
Across the pond, however, the environment was a bit tougher, and it's vital we look at both the wins and the challenges. The Unum UK line of business saw its segment-adjusted operating income decrease by 48% in local currency. Now, this wasn't a failure of sales, actually. Premium income grew by 5.2% over there. The drop was primarily due to severe economic headwinds, specifically lower income from inflation index-linked bonds. Combine that with higher average claim sizes in their group long-term disability products, and it pushed their benefit ratio up to 82.2%.
Section 5. Navigating the closed block. Okay, this segment often causes the most confusion for people. While the initial numbers might look like a severe headwind, they require broader context to truly understand Unum's strategy here. The closed block segment did report an adjusted operating loss of $75.4 million this quarter, driven by lower net investment income and the amortization cost related to the 2025 Fortitude reinsurance transaction. Standing alone, a $75 million loss sounds alarming, right? But that is only half the story. So the crucial point is that this legacy risk is heavily insulated. The company has robust protections at their Fairwind entity, backed by statutory reserves and excess capital of approximately $2.2 billion. So while the block runs at an operational loss on paper, the long-term risk profile is deeply, deeply secured.
Finally, Section 6, Outlook for 2026.
Let's zoom back out. We've gone from macro revenues down into specific product lines and legacy risks to bring our top-down narrative full circle. Based on the detailed breakdown of the second quarter we've just walked through, balancing the really high-performing life segments in Colonial Life against the headwinds in UK investments and short-term disability, the pivotal question becomes this: is Unum Group positioned for a strong finish as we move through the rest of 2026? Well, management certainly believes so. They are projecting a very strong upward trajectory, providing a full-year 2026 outlook targeting an after-tax adjusted operating income of $8.60 to $8.90 per share. When you compare that to their 2025 result of $7.93 per share, you're looking at an expected growth of 8 to 12%. These are highly positive target numbers that really anchor the company's expectations for continuous, steady expansion.
Which leaves us with a final thought to ponder. We've seen a quarter characterized by massive liquidity, strategic share repurchases, localized claims headwinds, and heavily fortified legacy risk. So what does this specific balance of robust core growth and tightly managed legacy risk mean for the future stability and pricing of your own employee benefits? It is a complex ecosystem for sure, and I highly encourage you to dive into the source material to explore how these financial mechanics shape the broader benefits market. Thanks so much for joining me for this explainer.